Welcome back. I want to start today with something that most financial content never acknowledges directly, because acknowledging it feels like it might discourage people. I'm going to say it anyway. Compound interest is genuinely frustrating in the early years, not because it doesn't work. It absolutely works, but because it works slowly at first. And that slowness is psychologically brutal for people who are putting in real effort and real sacrifice and watching numbers that feel like they barely move. You save $200 a month, you invest it properly, you leave it alone like every piece of advice tells you to, and a year later, your balance has gone from $2,400 to $2,616. You've been disciplined for 12 consecutive months, and the market generated $216. That's a round of takeout food. It doesn't feel like wealth building. It feels like saving money in a very complicated jar. And this frustration, this "is it actually working" feeling is one of the primary drivers of what behavioral finance researchers call contribution abandonment, the point where savers stop investing, redirect the money to consumption, or convince themselves the whole system isn't for people like them, which is tragic because they're quitting at exactly the phase where the investment of time is highest, but where the payoff is still invisible. Today, I want to fix that feeling with something concrete, a framework called the 8-4-3 rule, a way of visualizing what compound growth actually looks like over a 15-year investment cycle that will fundamentally change how you experience the early, frustrating years. Let me show you what I mean. Research by behavioral economist Shlomo Benartzi and colleagues on long-term savings behavior found that one of the strongest predictors of investment contribution abandonment was what they called progress invisibility, the perception that contributions are not producing visible results. This perception was most common in the first 5 to 7 years of investing, when portfolio returns in absolute dollar terms are too small to feel meaningful relative to personal contribution effort. Investors who received concrete visualizations of their long-term compounding trajectory showed significantly lower abandonment rates, suggesting that the problem is not the mathematics of compounding, but the psychological experience of it in real time. Chapter 1. Why compounding feels slow, the cognitive mismatch. Before we get to the 8-4-3 rule itself, I want to explain why compounding feels slow even when it's working exactly as it should. Because the feeling isn't irrational, it's a predictable result of how the human brain is wired to understand growth, colliding with how exponential growth actually operates. Human beings are wired for linear thinking. We intuitively understand arithmetic progression: 1, 2, 3, 4, 5. Every step adds the same amount. It's predictable, visible, and proportional to effort. When you work one more hour, you earn one more hour's wage. When you save $100 more, your balance goes up by $100. Linear growth is deeply intuitive because it mirrors most of our daily experience. Exponential growth, the kind that compound interest produces, is fundamentally different in structure. Early on, it looks linear and unremarkable, but its nature is to accelerate, not add. Each period's growth is based on the prior balance, which means each period's dollar gains are larger than the last, not by a fixed amount, but by a multiplying factor. The result is a curve that looks almost flat at the beginning and then rockets upward in the later stages in a way that feels sudden, even though it was completely predictable from the start. Nobel Prize-winning physicist Albert Bartlett, who spent decades studying exponential growth, argued that humanity's greatest intellectual failing was the inability to intuitively grasp exponential functions. In mathematical terms, exponential growth is characterized by a constant growth rate applied to an ever-increasing base, meaning the absolute dollar gains per period grow continuously, even as the percentage rate remains the same. This is why a 10% annual return on $10,000 produces $1,000, while the same 10% on $100,000 produces $10,000. Same rate, 10 times the result. Our brains expect the second scenario to require 10 times the effort. It requires exactly the same patience. The early years of compound investing feel unrewarding precisely because the base is small. When your base is $5,000 and it earns 10%, the gain is $500. You worked hard to save that $5,000 and the market gave you $500. A year's contribution is $2,400 and the return added $500. $2,500. Together, $2,900. Not inspiring. But here's what that same 10% looks like 20 years later on a $200,000 balance. It adds $20,000 in a single year. In 1 year, the portfolio gains more than 10 months of your current annual contributions without you lifting a finger. That's the same math, the same rate, the same rule, just applied to a larger base. The 8-4-3 rule is a way of seeing this acceleration clearly before it happens, of understanding the compounding timeline as not very slow for 15 years, but as changing character dramatically at predictable points. Let's look at it.
Chapter 2. The 8-4-3 Rule. A new way to see the journey. The 8-4-3 rule describes the compounding timeline of a consistent monthly investment, typically used with an assumed average annual return of around 12%, commonly cited in Indian financial planning literature, which popularized this framework, or with 10% for U.S. markets, broken into 3 distinct phases based on how long it takes to double the portfolio from each starting point. Here's the core observation that makes this rule so compelling. At a consistent annual growth rate, each successive doubling of your portfolio takes less time than the last. Not a little less time, dramatically less time. And when you see it laid out, the slow compounding frustration starts to look very different. Let me walk through the 3 phases using a concrete example. We'll use a monthly investment of $1,000 and an average annual return of 12%, the rate commonly used in long-run emerging market equity calculations, though we'll note U.S. equivalents too. Phase 1, the first 8 years, to the grinding phase. Balance, approximately $161,000. Gained this phase, $161,000. This is the phase that breaks most investors. Over 8 years of consistent $1,000 monthly contributions, your total out-of-pocket investment is $96,000. The portfolio grows to approximately $161,000. The market added roughly $65,000 in gains on top of your contributions. That is real money, but it arrives slowly, in small monthly increments, invisible against the backdrop of the effort being expended. Monthly returns of $1,000 to $3,000. Not life-changing, not visually dramatic, just the machine quietly building the base it needs. Phase 2, the next 4 years. Years 9 through 12, to the acceleration phase. Balance, approximately $322,000. Gained this phase, $161,000. The portfolio doubles again, but this time it takes only 4 years, half the time of the first phase, to add the same $161,000. Why? Because now there's a $161,000 base generating 12% annually, which is roughly $19,000 per year just in investment returns without a single new contribution. Monthly returns have grown to $5,000 to $8,000. Suddenly, the machine is doing real work. The monthly return is now approaching the monthly contribution. The 2 engines, your savings and the market, are pulling roughly equal weight for the first time. Phase 3, the next 3 years, years 13 through 15, to the explosion phase. Balance, $644,000. Gained this phase, $322,000. The portfolio doubles again, but this time in only 3 years. In a single 3-year stretch, the portfolio gains more than it gained in the entire first 8 years combined. Monthly investment returns are now $15,000 to $20,000, 10 to 15 times what monthly returns looked like in year 1. The machine has taken over. Your contributions at $1,000 per month are a minor footnote compared to what the portfolio is generating on its own. The dynamic has completely reversed. Compound growth is now doing more work each month than you are. Read those 3 phases again and let the structure sink in.
8 years to reach $161,000, 4 years to double it to $322,000, 3 years to double it again to $644,000. The same $1,000 monthly investment, the same 12% return, the same market, but the experience transforms from frustratingly slow in phase 1 to visibly accelerating in phase 2 to almost self-propelling in phase 3. The key insight of the 8-4-3 rule. The slowness you feel in the early years is not a sign that compounding isn't working. It's the necessary phase that builds the base large enough for compound growth to generate meaningful absolute dollar returns. You're not waiting for compounding to start, you're waiting for the base to get large enough that compounding becomes visible. Those are very different things. Chapter 3. The math that makes it all work and why it's inevitable. The Rule of 72. Predicting every doubling. The acceleration pattern in the 8-4-3 rule isn't magic, and it isn't specific to any particular investment strategy. It's a direct mathematical consequence of compound growth, specifically a property elegantly captured by the Rule of 72. The Rule of 72 states that the number of years it takes for an investment to double in value is approximately equal to 72 divided by the growth rate. At 12% annual growth, 72 divided by 12 equals 6 years to double. At 10%, 72 divided by 10 equals 7.2 years to double. At 8%, 72 divided by 8 equals 9 years to double. The key is what happens to your wealth trajectory across multiple doubling cycles. If you invest a lump sum today and leave it, no additional contributions, it doubles every 7 to 9 years at 8 to 10% return. That means today you have $1, in 9 years you have $2, in 18 years you have $4, in 27 years you have $8, in 36 years you have $16. Each 9-year cycle adds more dollars than all previous cycles combined. The 27 mark adds $4 in one cycle. The 36 mark adds $8 in one cycle. Same time, same rate, geometrically larger gains. The Rule of 72 was documented as early as the 15th century in the work of Luca Pacioli, the Italian mathematician who also documented double entry accounting. It has since been validated as an accurate approximation for compound growth at rates between 6 and 20% annual return. More precisely, the mathematical proof relies on the natural logarithm. ln of 2 divided by growth rate gives the exact doubling time, which the Rule of 72 closely approximates by substituting 72 for the mathematical constant 69.3, 100 times ln 2. The approximation works because 72 is divisible by many common interest rates, making mental calculations convenient without meaningfully sacrificing accuracy. The additional contribution effect. The 8-4-3 rule, as described above, includes the effect of ongoing monthly contributions. You're not just growing a lump sum, you're also adding to it each month. This makes the early phases both harder and the later phases even more dramatic than a pure lump sum calculation would show. In the early years, your contributions represent the majority of the portfolio's growth. The market's return is small because the base is small. You are doing most of the work. This is exhausting and unrewarding, and it's why so many people quit. In the later years, the dynamic inverts. The portfolio's base is now large enough that its annual return in dollar terms exceeds your annual contributions. You are doing a minority of the work. The market is carrying you. This is the moment investors who stayed in phase 1 get to experience, and it is everything the frustrating early phase promised it would be. Research on the wealth accumulation dynamics of consistent long-term investors, drawing on Ibbotson Associates' historical U.S. market return data and extended by Morningstar through 2024, shows that for investors with 20-plus year horizons, investment returns from compound growth account for a progressively larger share of total portfolio value over time. In the final decade of a 30-year investment journey, investment returns typically generate 60 to 75% of total portfolio growth, with contributions accounting for only 25 to 40%. The front-loaded effort backloaded front-loaded reward structure of compound investing is not a flaw. It is the designed architecture of how exponential growth works over time. Chapter 4. The 8 years that break most investors and how to survive them. Phase 1 of the 8-4-3 rule is where the battle is won or lost. Everything you see in Phase 2 and Phase 3 depends entirely on whether you stay invested and consistent through the unglamorous first 8 years. And the research on why people don't stay in is specific enough to be genuinely useful. The primary killers of Phase 1 progress. Financial researchers and behavioral economists have documented the specific mechanisms that cause investors to abandon compounding during Phase 1. The most common are contribution abandonment from progress invisibility, the feeling that it's not working despite evidence to the contrary. This is addressed precisely by the 8-4-3 framework. Understanding in advance that Phase 1 is supposed to feel slow is the cognitive inoculation against quitting it. Emergency withdrawal. An unexpected expense forces an early withdrawal from the investment account because no liquid emergency fund was maintained separately. The withdrawal disrupts the compound growth cycle, incurs penalties in retirement accounts, and often triggers a psychological reset that makes restarting contributions harder. Lifestyle inflation consuming the contribution. A raise or income improvement quietly absorbs the monthly investment amount into expanded spending before it reaches the investment account. The balance plateaus. Phase 1 extends indefinitely, and the compound growth curve never accelerates into Phase 2. Market downturn panic selling. A 20 to 40% portfolio decline in Phase 1, when the balance is small enough to feel devastating, triggers an emotional sell. This converts a paper loss into a permanent one and misses the recovery that historical data shows reliably follows every major market correction. J.P. Morgan Asset Management's annual Guide to the Markets report documents one of the most consistent findings in investor behavior research. Missing just the 10 best trading days of the S&P 500 over a 20-year period reduces annualized returns from approximately 9.8% to 5.6%. 7 of those 10 best days occurred within 2 weeks of the 10 worst days. This means that investors who sold during downturns and waited to reinvest, a classic Phase 1 behavioral failure, systematically missed the recovery and permanently reduced their compound growth trajectory. The reframe that changes everything. Here is the most important cognitive reframe for surviving Phase 1, and it comes directly from the mathematics of the 8-4-3 rule. The work you do in Phase 1 is not just saving money, it is building the base that Phase 2 and Phase 3 will multiply. Every dollar you invest in year 1 will be worth dramatically more in year 15, not because you did anything clever, but because it had more time to compound through successive doublings. Think of Phase 1 as the foundation of a building. You can't see the building when you're pouring concrete and laying rebar. It looks like a construction site. It looks messy and unimpressive and slow. But the height of the building that eventually gets built is directly determined by the quality and depth of the foundation. Phase 1 investors who stay consistent are pouring a deeper foundation, and the building that gets built on it will be proportionally taller. Research on goal persistence by psychologist Gallwitzer and colleagues found that forming specific implementation intentions, pre-commitments to specific behaviors in specific circumstances, dramatically improved follow-through on long-term goals compared to relying on motivation alone. For investors, this translates directly. Forming a pre-commitment like, when the market drops 20%, I will not sell and will instead continue my automatic contributions, produces significantly different behavioral outcomes than simply intending to stay invested. The pre-commitment changes behavior at the moment of decision by shifting from an in-the-moment choice to a pre-made rule. Chapter 5. Applying the 8-4-3 rule to U.S. market returns. The 843 rule, as originally articulated, uses a 12% assumed return, a figure drawn from long-run emerging market equity averages, particularly relevant to Indian markets where this framework gained popularity. For U.S. investors, the historically appropriate average annual return for a broad S&P 500 index fund is approximately 10% nominal, or 7 to 8% after adjusting for inflation. At 10% annual return, the doubling time via the rule of 72 is approximately 7.2 years, so the 843 structure becomes something closer to a 954 rule for U.S. investors, still dramatically accelerating across phases, but with slightly longer timelines in each phase. The core insight remains unchanged. Each successive doubling takes less time than the last, and the later phases deliver the same dollar gains in dramatically shorter time frames. Let's make this concrete for a U.S. investor putting $500 per month into a low-cost S&P 500 index fund from age 25. From age 25 to 34, 9 years, total contributions of $54,000. The portfolio grows to approximately $95,000. Market generated about $41,000 in gains. This is phase 1. The grind. From age 34 to 39, 5 years, portfolio grows from $95,000 to approximately $190,000, an additional $54,000 in contributions plus market gains. But notice, the portfolio added as much in 5 years as it did in the previous 9. Phase 2 has arrived. From age 39 to 43, 4 years, portfolio grows from $190,000 to approximately $380,000, another doubling in only 4 years. Monthly investment returns now rival or exceed the monthly $500 contribution. From age 43 to 56, 13 years to retirement, with the portfolio's compounding engine at full power on a $380,000 base, the growth to age 56 produces a portfolio approaching $1.5 to $2 million, depending on contribution increases, almost entirely driven by compound growth rather than contributions. These projections use the S&P 500's historical nominal return of approximately 10% annually, documented in Ibbotson Associates' SBBI yearbooks and Morningstar's historical return data spanning 1926 through 2024. Over every rolling 20-year period in this dataset, the S&P 500 has delivered positive real returns. The long-run consistency of this return, not in individual years, which are variable, but in rolling decades, is the empirical foundation that gives the 843/954 rule its mathematical credibility as a planning framework. Chapter 6: How to Move Faster Through the Phases. The 843 rule describes what happens at a fixed contribution rate over time, but the timeline is not fixed. It's a function of how much you contribute and when. There are 2 levers that can dramatically compress the timeline from phase 1 to phase 3, and both are within your control. Lever 1. A higher initial contribution. The single most powerful way to reach phase 2 and phase 3 faster is to contribute more in the early years, specifically to start with a higher monthly contribution rather than one you plan to increase later. This is counterintuitive for some people because it feels like there will always be time to increase contributions, but the mathematics of doubling time means that money contributed in the early years goes through more doubling cycles than money contributed later. A person who invests $1,000 per month from age 25 versus $500 per month will not simply end up with twice the portfolio, they will end up with substantially more than twice because the additional $500 per month in the early years compounds through more doubling cycles. The extra contributions in year 1 have 30-plus years to double and redouble. The extra contributions in year 20 have only 10 to 15 years. Front-loading contributions is one of the highest leverage financial decisions available to young investors. Lever 2. The savings rate escalator. The second lever is a commitment to increasing your monthly contribution with every income rise, a strategy that behavioral economists call commitment escalation or the save more tomorrow approach. Rather than relying on motivation to save more when income rises, you pre-commit to redirecting a fixed share of every raise to savings before the lifestyle adjusts to the money that was automatically redirected. Thaler and Bainartzi's Save More Tomorrow program, published in the Journal of Political Economy and widely replicated, found that participants who pre-committed to directing a fixed share of future raises to savings increased their savings rates from an average of 3.5% to over 13% within 4 years, with essentially no reported financial hardship because the lifestyle never adjusted to the money that was automatically redirected. For compound investors, this approach is a phase 1 compressor. Each raise-driven contribution increase shortens the timeline to phase 2 by building the base faster. Let me close with the reframe I want you to carry out of this episode. If you're in the early years of investing, if you're in phase 1, grinding through the slow, invisible, unrewarding first years of compound growth, I want you to change the story you're telling yourself about what you're doing. You're not in the slow part, you're in the foundation part. The slow part is an optical illusion created by looking at absolute dollar returns without context. The reality is that every dollar you invest in phase 1 is doing the hardest and most valuable work of your entire investment journey. It is going to experience the most doubling cycles, generate the most compound growth, and contribute the most to the portfolio that phase 3 you will look at with something approaching disbelief. The 8-4-3 rule is not a guarantee. It's a framework for understanding what patient, consistent investing looks like over time at historical market return rates. Markets have bad years. Sequences of returns vary. Individual results differ. But the mathematical structure, the fact that each successive doubling takes less time and produces more absolute dollars than the last, is not a projection or a prediction, it's arithmetic. It's the nature of exponential functions applied to invested capital. Compounding isn't slow. It's patient, and the difference between those two things is everything. Thanks for watching. If the 8-4-3 rule changed how you're thinking about your investment timeline, drop it in the comments. Where are you in the phases? Are you grinding through phase 1? Have you hit phase 2 and felt the acceleration? Share this with someone who's about to quit because it feels like it's not working. Subscribe for the next one. See you there.